The company vanished. How did this happen? Borders was once a national retail powerhouse. It ran hundreds of stores, hosted thousands of community events, and employed thousands of people. In the early 2000s, it generated predictable cash from in-store traffic and a supply chain built for big boxes. Then one boardroom decision set a cascade in motion. In 2001, Borders signed away its online storefront to a rival. That move immediately handed over the transaction engine and customer relationships. Executives gained an instant digital presence. They also seeded the data that turns repeat buyers into lifetime customers. The risky decision was simple. The consequence was durable. For a few years, the metrics looked tidy. Borders reported online sales without the capital expense of building and operating a full e-commerce platform. Quarterly headlines improved. Investors accepted the numbers. Store managers celebrated that customers still walked in. Momentum had flipped into an apparent win. Momentum was misleading. Retail habits began to shift. When online orders placed through the outsourced storefront arrived at customers' doors, they arrived with someone else's invoice and recommendation engine. The customer purchase history lived on the competitor's servers. Borders kept the receipt. Amazon got the relationship. Warning signs followed and grew louder. Repeat customers who once asked a bookseller for a recommendation started ordering from home. Marketing lost its leverage because Borders did not control first-party lists. Promotions that had reliably driven weekend traffic produced smaller bumps. Inventory turnover slowed. Carrying costs rose. Each missed targeted offer was a lost chance to cross-sell a high-margin item or drive a store visit. In 2005, Borders doubled down on physical media. The company expanded CDs and DVDs in stores. That was a clear bet on continued foot traffic and on margins anchored in in-store impulse purchases. It was also a counter-trend decision. Consumers were already testing online convenience. The expansion of physical entertainment filled space with inventory that required customers to come in, browse, and buy. Instead, those customers were increasingly completing transactions where the data and the fulfillment lived. Online. The losses escalated stepwise. Initially, Borders missed incremental revenue on every online purchase, routed through the outsourced partner. That eroded margins and undercut the effectiveness of local promotions. Next, competition on price and fulfillment speed from the platform partner and its marketplace accelerated the migration away from store purchases. Finally, the company lacked the years of accumulated data and the recommendation algorithms that shape repeat behavior. By the time Borders attempted to relaunch its own digital storefront and strike device partnerships, core customers had moved. Rebuilding cost far more than the short-term savings gained by outsourcing. Store managers felt the pressure first. They faced excess stock. Holiday crowds thinned. Sales per square foot declined. Marketing teams could not target lapsed buyers with personalized offers because the buying history did not belong to Borders. Executives saw margins compress, while rent, distribution, and inventory costs stayed fixed. Debt mounted. Each quarter's shortfall forced more aggressive measures. Each measure reduced the company's ability to invest in catching up. The market itself accelerated the danger. After 2007, the rise of e-readers and digital delivery changed reading behavior. An ecosystem of devices, digital catalogs, and recommendation engines grew around platforms that owned the customer interface. Borders tried late pivots. Those moves were expensive. They were also late. The competitor had years of behavioral data, fulfillment scale, and an expanding marketplace. Those advantages produced network effects that drew more vendors, more buyers, and more personalized discovery away from any late entrant. At midpoint, stay with this story. The turning point was not a single headline. It was a compound failure to regain a core strategic asset, first-party customer relationships, and the behavioral data they produce. Borders' late investments in its own site and device deals could not recreate years of interaction histories. The company faced re-entry costs in technology, logistics, and customer acquisition that outmatched its remaining cash and credit flexibility. The math of lifetime value favored the platform that had been collecting it. Consequences escalated into crisis. Same-store sales declined. Inventory built up. Store closures began. Layoffs followed. Creditors tightened terms. Boarders filed for Chapter 11. Protection and ultimately liquidated. Hundreds of stores closed. Thousands of employees lost their jobs. Communities lost civic spaces for discovery, discussion, and author events. The recognizable retail brand that had anchored neighborhoods vanished. Institutional fallout extended beyond shuttered doors. Landlords absorbed empty leases. Suppliers lost a major channel. Creditors recovered a fraction of claims. The national bookselling landscape consolidated around surviving chains and dominant online platforms. Local cultural ecosystems, reading groups, school partnerships, weekend routines, unraveled in places where borders had been the hub. A forensic economic reading makes the core loss explicit. The immediate dollar impact mattered. So did the strategic loss of lifetime customer value, cross-sell opportunity, and network effects. Outsourcing a transaction platform produced short-term balance sheet relief. It also created a durable disadvantage: loss of first-party data, loss of control over personalization, and loss of an owned channel to convert a buyer into a loyal customer over years. Those are not reversible with late, high-cost engineering projects. Human impact tracked the economic decline. Booksellers who curated local shelves lost livelihoods. Store managers who had hired and trained teams watched stores empty and employee schedules cut. Regular customers lost weekend routines and author nights. Small towns and mall communities lost a place where people discovered books together. The cultural damage is not fully quantifiable. The economic portrait is stark. A dynasty undone when the strategic asset that powers modern retail, the customer relationship, was handed to a competitor. The final lesson is precise. Short-term cost avoidance can mask long-term strategic loss. Seeding the transaction platform and customer data is not an operational shortcut. It is a migration of ownership. When habits shift and platforms scale, the absence of years of customer data and the recommendations that flow from it becomes an insurmountable moat. Borders' choice in 2001 and its decision in 2005 to lean into physical inventory together illustrate what I call late mover blindness, a company that doubled down on the old model even as the assets that defined the new model slipped away. Learn the warning signs.